Hi, I'm Johanna Botta from StoneX. Markets in Asia and Europe have opened in the red today, as President Trump's Liberation Day tariffs are properly digested by financial markets. Ahead of the U.S. Open, I'm joined by Alex Ridgers, StoneX's global head of retail dealing. Alex, thank you so much for being here.
Pleasure.
So, given the growing perspective that Trump's tariffs are designed to force a Fed rate cut, what are your expectations for future rate moves and their impact on market liquidity?
Well, I think it's really interesting what we've seen again initially, and the outlook going forward. There's in the next 12 months we're seeing 5 rate cuts now, and so that's gone up, but not a dramatic move. And I think where we tend to get to with central bankers, they're very afraid of doing anything that harms, and almost we wait for a destabilization event to cause a significant jump from one level to the next. So there's a lot of people around thinking that that's exactly what Trump's trying to cause. But so far, that sort of 5 percentage point cut isn't quite what I call a destabilization event, but it's not to say we won't get there, if you see what I mean.
Yes. So, how do you anticipate tariffs impacting the US dollar then in the near term?
Well, I mean, it's been very interesting so far. We've seen a 1.5% drop in the dollar index, so nothing dramatic. And if you look at particular currencies, you would see a more dramatic move either way. So and actually it's very interesting when we think about our retail clients that for the last sort of 12, 18 months, normally they've got a position one side, sort of a basket of currencies against the dollar, long or short. And very much now it's really a case that we've got some long, some short, and we're neutral to the dollar, which is very rare for us. So the dollar move has actually almost been inconsequential. So we've seen yen and euros strengthen. And it seems to me that the play partly is the euro, the new sort of reserve currency of choice in the US, globally. And when we look at other currencies, the Aussie dollar has been the big sort of faller. If you were to look at the sort of the Aussie dollar graphs, you'd be, wow, the dollar's strengthening. You know, when really it's not. And again, it's one of those mining currencies that, again, it's sort of mining commodities focused. Whenever commodities take a hit, which it's been a terrible sight on that side as well, and that's to be expected in the Aussie. And then sort of finally, again, I know we're sort of talking about the dollar predominantly, but the sort of the pounds almost stuck somewhere in the middle of initially pound strength because Britain's got the lowest tariffs, but now there's sort of that question, and going back to again to dollar rate decisions, I think the pound's in a similar place to the dollar, where there's a lot more to fall, or there's a far more room to fall for the pound and the dollar as base rate compared to something like the euro. So for me, the dollar could still be weakening a lot because, again, if of course we're at a crossroads. Will Trump still do? Will he really go through with everything?
We're waiting. I mean,
yes,
what is
exactly.
it? April 7th today.
Yes, but so for me, in terms of sort of dollar expectations and base rate expectations around the world, this is sort of where I feel where we are. Where we've got the dollar and the pound with a lot, around 4.5%, with a lot more to go. Whereas the euro's almost held up because it's like, well, we're in the 2 handle percent, so therefore, is there really much weakness to come on that side?
Well, then, given the Asian and European reactions to Liberation Day, is what we're calling it, how do you anticipate volatility and liquidity in key markets at the U.S. Open?
We get, I mean, I suppose we've seen, you always get the drama around markets dropping. And again, we've already seen US futures drop this morning. So in that sense, and actually in the last half an hour or so, there's been a bit of strength on that side. I mean, of course, it's a will he, won't he play. And
It's a waiting game.
yeah, for me, one of sort of I always think the funny things is that, we had the same panic in the crisis in Britain, and when Liz Truss was in power again, she sort of put in her plans and sort of crashed the markets. And ironically, there's only 7 letters of the alphabet between Trump and Truss.
And
so
we're still feeling those effects, may I
exactly.
say, or my mortgages.
Yes, exactly. And I think this is almost, for me, quite a crucial thing, that those policies quickly were reverted, but the lasting impact on the markets remained. And when we think of Liberation Day and the tariffs, if Donald Trump were now to come in and say, actually, we're going to sort of draw back some, we've had good conversations with other leaders, we don't need to implement quite as much because they're cutting their side as well, the damage is already done, which is to rates, which is probably what Trump wants, without maybe the lasting impact. So that's one angle. You know, I always try and put a positive spin on these things. You know,
Very optimistic.
lower interest rates again is better liquidity for the market. But you know, it seems a sort of a crucial morning almost that now we're starting the week for some sort of progress to be made between countries over the weekend that I don't think would probably be announced before the US is awake. That would almost seem rude from other leaders to do these things. So one side there is a powerful argument to say, well, markets could rally, but then again, if Donald Trump comes out and says, well, no, I'm sticking with this, then I think for me the only thing holding the markets up is that sort of optimism that, like many things Donald Trump has said before, they're not always carried out to their full extent.
So what is your recommendation there to traders out there trying to navigate these volatile times?
Well, yeah, good question. So I think retail traders and actually hedge fund traders around the world, they always really struggle to gauge quite how volatile markets can go, and even ignoring the term volatility, just the simple ranges that these markets can be hitting. So for me, as a retail trader, what would I be thinking doing? Again, it's trying to adjust my brain to quite the scale, and and in these markets, of course, clients can make a fortune, but of course they can lose a fortune. We have to present both sides. So it would be actually stop losses that sometimes you think aren't there for a reason. In a low volatility environment, clients can get frustrated because their stops get taken out and the market's oscillating and not really doing anything exciting. Whereas now, I think that sort of prudent risk strategy, get rid of your losses, but there are still big gains. But keep running your profits. That would be my advice, without obviously saying anything about direction.
I'd say that's very good advice. Thank you, Alex. And thank you guys for watching. For more info and more content from StoneX, please like and subscribe.